Welcome back.
Today's been a positive update.
It's the hard love day. That's right. No, it's last week was more difficult than this week, I think. So, all right. We'll wait just a minute here. And so as we're just getting settled here, is there any burning questions from last week that on top of your mind? No? You got it all figured out.
Save that for later.
Okay. All right. Let's go ahead and start. Of course, we get to share our disclosures every time. All right, so we're in section 6, which is protecting against market loss. So I guess the first concept here is to understand the rule of 72. Okay, and you may be familiar with that. It's a simple way to calculate how long does it take for your money to double based on the rate of return. Okay, so if you're getting an 8% over time, your portfolio will double in 9 years. And so you can just kind of, but pretty much regardless of what your rate is, um, during a 20, 30-year retirement, you know, something that I tell people, clients a lot of times, we're sitting there and they're looking at their portfolios. They're thinking about, this is our nest egg. This is what we've got for retirement. What I tell them is actually most of the money that you're going to be spending in retirement, you don't even have yet. You haven't even earned it yet. Because your portfolio is going to grow. You're going to have Social Security, it's other sources of income that you actually don't have yet. And you put that together and it becomes substantial. And that's what makes it work, right? We've got to obviously stay ahead of inflation, which is important. But you can anticipate a portfolio doubling based on whatever your return is in a fairly short amount of years, right? Now, of course, if your portfolio is really small, doubling doesn't, if you have $100, it becomes 200, that's not a really big deal. But if you've got $1 million and it becomes 2 million, it's, and then we go from 2 to 4. And sometimes we'll put together a plan and clients are surprised to see that even though they're spending all this money, they've got a pretty significant chunk that's likely to be left over. Or that means they could actually spend more, right, than they thought. All right, so let's talk about volatility. This chart goes back 127 years, looking at the Dow Jones. It's the oldest and longest index that we have. So this is back in the late 1800s, and it comes about to 2023. So what you can see is the market is cyclical in nature. It always has been. So we can go through, fairly extended periods of time of a bearish market, and then we can go through some extended periods of time where it's bullish. And this is what we call the lost decade. This was the 2000s, right? If you had money in the market in the year 2000, 10 years later, you were about even because there was so much loss. So your money really didn't grow, but anyway. So right now, we've actually been in a very long, extended bull run for the most part. I mean, there's been some dips along the way. But the question is, is this what we have for the rest of our retirement, or do we have some of these in our future? Of course, we know there's going to be some periods of bearish years, but and I've been doing this a long time, and it's interesting to see folks who, we kind of have short-term memory when it comes to the market, because if the market's been going great for 13, 14 years, People just start to expect it to be that way. And if you can remember living through this time period, and here's let's zero in on that time frame. You remember 2008, I'm sure, right? So this was the year 2000. This is the dot-com bubble burst, and then it was followed by the September terror attacks. I mean, it was almost 2.5 years. It just felt like the market was just not ever going to go up, right? Down, down, down. It lost almost 50% of its value. I personally lost a ton of money during that time, and it was not fun at all. Of course, the market it's always rebounded, right? It's a matter of how much time does it take. And so we're about back to where we were once we hit 2007, and then we had the mortgage crisis, and the market fell off the cliff, and a full 56% of the S&P was lost during that time. And so for about a year and a half, it was just so bleak, right? And especially if you had real estate, it wasn't just stocks, right? Real estate market really took a dive. But of course, in time, it's rebounded, and now we're way up in here, all-time highs. So we're going to look at this a couple different ways. Just the concept of modern portfolio theory. I don't know if that's a term you've heard, but it was designed by Harry Markowitz. He was an economist, back in the 50s. And his theory it became very broadly adopted. And so even to this day, most of the time you're going to find a modern portfolio theory approach is being used. The concept is simply the higher return you want, the more risk you're going to need to assume. So in this case, it's assuming 100% stocks. And then the curve goes like that. So 30% bonds to stocks, 40-60, 50-50, and so on. And this would be 100% bonds, which would be considered the least risky. But are bonds risky? If you had bonds in 2022, you know how much you can lose in bonds in a hurry. But we'll talk about that. But this is traditional asset allocation. It's kind of the 60-40 portfolio or some variation of that. What every wise financial advisor will tell you is the importance of diversification. And but you need to understand what diversification can do for you and what it cannot do for you, okay? So there are two types of risk, two types of market risk. One of them you can diversify, and the other you cannot, using traditional asset allocation, okay? So for example, and welcome, by the way. The first one is what we call unsystemic risk, okay? Unsystemic means it's not going to affect everybody and everyone. It would be a specific investment with a specific company, okay, or a specific stock, for example. You can have a key employee die, or a CEO die, or a strike, or some major thing that the stock just plummets, right? An example of that would be Enron. Remember Enron? They were a huge energy company, looked very promising. Their stock was trading at $90 a share, and then very quickly went all the way to zero. And so that's an example of unsystemic risk. Did the whole market do that? No, it was only that one company. And so that's unsystemic risk. That type of risk is the risk that you can protect yourself against with diversification, and you absolutely should, right? And so diversification works for that kind of risk. The other type of risk is systemic risk. So it would apply to the whole market. So an example is going to be a war, a terror attack, any kind of a major crisis or upset where the market really gets scared and drops. So an example here, well, I'm going to show you an example in a minute. But there is no amount of diversification using traditional asset allocation that will protect you against systematic risk. Okay, so that's a concept you want to understand. If you're using the traditional model, which a lot of folks are, and that only, you have, there's a good amount of risk. So we got to understand what does that mean to us at this stage of our life, right? So looking at a sample portfolio, a very well diversified portfolio from 2004 to 2009, where there was a lot of volatility. We're going to say let's assume we're going to put 25% into the Russell 2000, 25% in the Dow, 25 in the Nasdaq, 25 in the S&P. If we were to do that, that's going to represent about 2,630 different companies. That's a lot of diversification. Okay. So what happened to a portfolio built like this during that time frame? So as you look at every single index, they all experienced the drop, right? So everyone, no matter how diversified, they all experienced the loss. Okay, so that's systemic risk. And so how do we protect against that? And that's we'll talk into how some of the strategies. So here's just a little example. Let's say we have $100,000, and let's just say we're assuming an 8% rate of return. After 2 years, we're up to 117,000. But what if in that first year, instead of being up, it was actually down 10%? How much of a return do we need in the second year just to get caught up? Any math wizards here? So it'd actually take a 30% return, right? Because you've only got 90,000 working for you. We've got to go from 90 to 117. That's going to take a 30% return. So here's some other conceptual examples. Let's say we have 100,000 and we experience a 40% loss. We now have 60,000. Okay. What if after the 40% loss, it's followed by a 40% gain? It kind of bounces. That sounds like, oh, we're down 40, we're up 40, we're good. Are we good? No, we're not good. We're actually down 16%. So, well, what if we had a 40% loss followed by a 60% gain? That sounds like surely we're going to be back, right? No, we're still down 4%. So how much of a return do we need? Following a 40% loss, we need a 67% return just to get us back. Well, how long might it take to get a 67% return? It's typically not going to be 1 year, right? Here's a chart. And this is what we were just looking at. But you can kind of look at whatever the drawdown percentage is, whatever the rate of return that you believe you're getting over time, and then it shows you the time frame. So it would have taken about 6.5 years to recover in that scenario, if with an 8% return. It'd take a full decade if we're getting 10.5. 5 years, 4 years. Anyway, so we become more sensitive to volatility in retirement than when you were prior to retirement. And I'm going to kind of show you that.
You got a microphone too.
What was the largest drop? How many percent in stock market? Is it
Largest drop in history. It's probably back in the Great Depression.
like how
Yeah.
much would that be?
I don't actually know the exact percentage drop.
I just want to see.
We have a chart, we can kind of look at it.
Okay. Thank you.
But yeah, 60%, I don't think it's ever. Now, it depends on what index you're looking at.
Mhm.
Like if you would just look at the NASDAQ and then we look at the year 2000, That was like a 70% drop.
Mm.
It was massive. The S&P was 50, but most of the, it was the dot-com boom
Mhm.
that really took a hit. So, do you have that answer, Johnny? Johnny,
Yes.
look it up.
I just looked it up. So it says the Dow Jones Industrial Average basically dropped 89% in its peak. The peak was 381.17 on September 3rd of 1929. And by July 8th, it fell to 41.
Okay.
So almost a 90% drop.
So almost a 90% drop. And that's the beginning of the Great Depression. That was intense. It has never been that severe. I mean,
Mhm.
if you look at, it depends on the index, right? So, I mean, the Dow Jones, it's an old index, but it only is tracking about 30 companies. So they're big, important companies, but it's still not a full representation. The S&P 500, you've got 500 of the bigger companies with all the different sectors. So it's typically the best benchmark of what's happening in the market. The NASDAQ, is heavy in tech. So you have to know what you're looking at, but yeah. So this is just a little trivia. Who knows where the symbols, the bull and the bear came from? Anyone? All right. So you can't say you didn't learn anything, right? So I'm going to teach on the 10th.
My friend, I said that was the best history lesson last week I've ever had. And today you're gonna exceed that.
Oh, well, thank you. Yeah, so it has to do with how they attack. So a bull, when he attacks, he flips his horns up, and the bear claws down. So the market's down, the bear, the bull are attacking. So that's where that came from. So you're never going to forget that, are you?
Yeah.
All right, so you have two options. Let's say you have two options. You can have option A, where you get an average return of 10%, or option B, an average return of 8%. Which one do you want? Now you probably say, well, of course 10. But what you really should be asking is, it depends on what the volatility is in the averages. Okay. So here, we're going out 5 years. This one, option A has volatility, some significant volatility, but it averages 10. Option B just gets us straight, there's no volatility, gets a straight 8. Look at the dollar amount. Significant outperformance. And so there is a cost to volatility. Here's another example, an average 10%, one growing to 161,000, the other 113,000. And so you just don't want to, averages can be very misleading. And it's because of what we showed, right? When it's down, you don't have as much working for it. It takes more of a return to recover. So recovering from losses. And when you're in retirement, volatility takes on a whole new meaning. It's really is different. If you go back to our mountain during the accumulation years, you can be way more tolerant of volatility. But there's a really key difference to retirement. It's not just the fact that you are older or have maybe less time. It's because you're taking withdrawals. That's the thing that's a big difference. On one hand, you're putting money in. On the other one, you're taking money out, and it adds a whole new element. The first rule of investing is to never lose money. Warren says Warren. The second rule, never forget rule number 1. So I'm gonna show you some different ways to protect against systemic risk. And that takes us to section 7, okay? All right, so 3 retirement pitfalls that are common. One is withdrawing money too quickly. So that's the withdrawal rate. How much can you safely take out for income and not have a fear of running out? The other is liquidating the assets in the wrong order, or I would say in in an inefficient order, right? And that has a lot to do with what we talked about last week, or the different types of accounts. And then getting a negative sequence of returns. Okay, so we're gonna go into each of these. Okay, pitfall number one, how much can you take for income? What's considered the safe withdrawal rate? Anyone have a percentage in mind? What was that? 4%, I hear? What'd you say?
Used to say 4%.
4%, yeah. Yeah, so 4% is the withdrawal rate. So where did that come from? It's a rule of thumb. It came from William Bengen, who was an economist in the early 90s. And he ran all these scenarios, Monte Carlo simulations, and he came up with 4% it would be considered safe. And so what that means is you withdraw 4%, you adjust for inflation each year, and you can take 4%. And the problem is it's not as safe as it once was because something has changed. What do you think there's actually a couple of things that have changed, but what do you think is one of the top reasons why a rule of thumb that was in the early 90s considered to be a safe withdrawal rate, and now it would be considered risky for most people? If they withdraw 4%, they're likely to run out of money prematurely. What do you think's changed? Any guesses? Living longer is actually one of them. Yeah, we actually need our money to last longer. But probably the bigger one, what'd you say?
Inflation.
Well, interest rates. So it's tied to that, yes. The biggest factor has to do with interest rates and bonds. So if we go back to when William Bengen came up with the 4% rule, the interest rates were close to 8% on bonds. Today, it's on a 10-year bond, we're about 4%. 1990, it was about 8%. And so, yeah, the traditional asset allocation model with that higher interest rate, it did work. But now, because bonds are not like they used to be, it's created some issues. So something to understand with bonds is that there's an inverse relationship between the interest rates and the value of your bond. Okay. So if interest rates rise, your value of the bond is down. Okay. So I just want to make sure I don't go over that too quickly. So when you have a bond, and then if you need to sell that bond because you're taking income, if interest rates have gone up, your bond is worth less, right? Why is it worth less? Because people can get a new bond with a higher interest rate. So why would they want your bond? You have to sell at a discount, okay? So if we go back to the 1980s, interest rates were super high, right? And if you look at the trend, it was just for decades, it was slowly tick down. You remember all through the 90s and in the 2000s and it was always, it's like every other month it seemed like, oh, it's time to refinance. Interest rates have gone down. And people would do that every 3 years. It's because interest rates would just trend down, down, down. And then we got to 2016 and they were at the lowest point ever. There were even some negative interest rates around the world, right? And then in 2022, we had this really abrupt spike. And so anyone who was holding bonds, especially in 2022, lost a lot of value in a short amount of time. And so, and now that peaked, and now we're down to about 4% now. So to understand that bonds are probably the worst performing asset in an inflationary environment. Out of all the assets, bonds are going to lose the most when there's inflation. So these are some other periods of time with high inflation. And you can see where the value of the bonds were dropped a lot. So this chart really kind of shows it where So if you're holding a bond and interest rates increase by 1%, and it's a 10-year bond, right? So the duration, 10 years is a very common duration, especially in retirement accounts. And so using traditional asset allocation, that is, 1% increase in interest rate and your bond is worth 10%. So it's a 10% loss. If we had inflation to where we had a 5% increase, I mean, you lose half the value just with the 5% increase in bonds. So bonds are very sensitive to interest rates. Now, if we look at equities, stocks, on the other hand, and these are some very inflationary years, right? Super high inflation. 1980, inflation was 13.5%. But how did the market do? The market actually did pretty well. So stocks are considered a hedge against inflation. If things are inflating, the stock market's usually doing well. Not the case in bonds. So again, I'm talking about traditional asset allocation. And so we're going to talk about a little later here what I would say some alternative allocations that kind of can solve some of these problems. Okay. All right, pitfall number 2 is the order of liquidation. And this is something that's like, okay, if you've got this type of account, it's tax status. So if you have a non-qualified brokerage account, for example, you've got an IRA, you've got a Roth IRA. If you have a pension or rental income, or maybe some earned income, or whatever the scenario is, what's going to be best? And Social Security comes into that. And a lot of this goes back to what we talked about last week with these different types of accounts and getting this right. And quite honestly, we use software to help us figure that out. And it's not something it's not something to easily project over 30 years. It's something that we can kind of project over 30 years with the best guess, but it's really something that's done on an annual basis. You're looking at, okay, for this year, we're looking at where the tax rates are, this bucket, this bucket, this bucket. Okay, so for your income, it should come out of these accounts. When you have that level of optimization, it's just impressive how much it extends your assets and your income. So it's the order of liquidation. Which accounts do you pull from when? Okay, pitfall number 3 is the sequence of returns risk. Now, most people, they don't really even understand, they don't really understand what that is, sequence of returns risk. It's like, well, I understand what market risk is, but what's sequence of returns risk? And the reason why most people don't understand it is because you've never had it. You've never experienced it during your accumulation years. When you're working and saving, there is no sequence of returns risk. Because so when we say sequence, we're talking about, yearly, was the market up or was the market down? The next year, was it up or down? The next year, what was the sequence of which years were up and which years were down? When you're not taking withdrawals and you're working and just saving, it doesn't matter what the sequence is. You could shuffle the years, the end dollar amount is going to come out the exact same. But it's a whole different story on the downside of the mountain, because now we're taking some income out. And so you remember how I showed if the market's down, it's difficult to recover. But now what if the market's down and you're taking some withdrawals at the same time? Now you just exaggerated, or whatever the right word is. You made it that much more difficult to recover. So here's kind of an example that should help. We have the Coopers and the Bradys. Okay, these are two couples. Everything about them, these two couples, is identical except for one thing, and that is the sequence of returns. Okay, so they both have $500,000, the start of their retirement. They're both retiring at age 65. They're both getting an average return of 9%. They're actually getting the same returns. They're just getting them in the opposite order. And they're taking the same withdrawal for income. They're adjusting for inflation at the exact same rate. And so how is it that the Coopers are completely out of money, age 80, while the Bradys have 2.1 million at age 95? And you think, could it really be that dramatic? And it really can. So it's just because of the sequence. So if you notice here, I mean, this is 2 million. So this is probably 3.5 million or something, right? You can see that they lost a big chunk of money. But because of their age and because of the amount, it didn't really hurt them, right? It wasn't devastating to them. They had some recovery and then they had another big loss. Didn't really hurt them. But these losses, the Coopers experienced early on. And so because the sequence was different and it was earlier in their retirement, they kept taking the same withdrawal for income, and it just, the portfolio could not recover. Even though it was averaging 9, it still couldn't recover. It lasted till they were age 80 in this example. But here's another example, just a different scenario. So you have scenario A, scenario B. So this is the exact same, okay, here are the market returns. These are actual returns of the market. The only thing different is scenario A, they retired 2 years earlier. In scenario B, they retired 2 years later. They both had 500,000. They had 500,000 2 years earlier than these guys, right? But this is the .com and the terror attack, right? Where the market was down. So they start off and boom, 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 3 years in a row of negative returns. These guys happen to have a couple of strong returns before the 3. And just that one difference, same withdrawal rate, same everything else. You see these guys completely run out years earlier, where these guys
Are they invested in the same thing?
exact same thing, exact same returns. It's just the S&P 500 is what we're looking at there. Yeah. So it's the timing. It's about the timing or the sequence. Okay. So if you retired like right here at the beginning of a big bull run, you're really lucky because that's just going to work really nice. But if you were retiring here, that would be devastating, right? Because the market's not growing and you're taking money out. So you are most susceptible. We call it the danger zone. It's really about 5 years before retirement and the first 10 years in retirement. So that 15-year window is when you are most susceptible. After that, you're not really so susceptible so much, and before that, you're not. So it's very much about the timing. Any questions about that? That makes sense?
Actually, I don't know.
Retiring early may be the thing, right? No, there's ways to protect against it. I'm going to show you. You just don't want to go with the default traditional, let's go stocks and bonds, because there's too much risk in that. There are ways to do it better. All right, we're going to look at 3 specific principal protection strategies. I will explain what a volatility buffer is and how that works. I'll also show you how to create leverage to get your money to do more than you maybe thought it could. So first, let's ask, if you were to just have this wish list, you would say, well, what is the perfect investment and what attributes would it have? And let's say, well, we'd like high returns. That'd be ideal. Like to have no risk at the same time. That'd be great. We'd like a tax deduction, we'd like tax-free growth, we'd like tax-free distributions. We're talking about perfect here, right? It'd be nice if it was all guaranteed. We want no RMDs to worry about, no penalties of any kind, no fees of any kind. And we want complete liquidity, use, and control of our money anytime we want. So does the perfect investment exist? It does not exist in any one vehicle, right? But if you look at these attributes, all of these attributes are available. They're all out there, right? So the question becomes, what's the most important attributes here? And what is the right combination for your plan? And that's where planning can make a big difference. Okay, so this comes out of my book. When I talk about investment tools to keep things, there's so many different types of investments. I like to categorize them into two groups: red tools or green tools. The red tools are going to be any type of investment where there's some chance of market loss. There's some downside risk, right? Certainly stocks, bonds, mutual funds, ETFs, derivatives, real estate, commodities, all of those types of investments, you have some exposure to the downside, right? There are green tools. FIAs, FIAs, DIAs, HECMs. We're going to talk about some of what these are, but these generally are guaranteed. They're generally coming from insurance companies. And so what you want to know, well, I guess the first question I'd say is, which one's better? And the answer is neither. It's what's the right combination again? What are the strengths? What are the attributes that you need in your portfolio? The red side has some very strong attributes that we need. There are some strong attributes on the green side that we can benefit at the same time. So I'm going to first kind of go into what I call a red tools discussion. We'll talk about investments, and then I'll go into the green. Okay. Now, again, this is where I apologize to the online folks, because those of you that are watching. So we have a little video here, and the audio is probably not going to be great, but bear with this. It's a short video, and then we'll talk about it.
Sure. That's not a old butcher. When you walk in, and there's a bunch of guys, no gloves, big white aprons, and there's Frank, and there's Stevie, and there's Mikey, and these guys know more about meat and more about animals, and more about cooking the meat than any of us will ever. And so you walk in and you say, "Hey, Lou, I do barbecue this weekend, right? What do you like?" And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. What do you got on skirt steak? Oh, we got some great stew skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite. Marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, good guy. Your cholesterol's getting high. Why don't you go down to the fish monitor a couple blocks, have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, so like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectation for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs. She's going to take all the measurements. She's going to run all of her analysis. And she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that. If she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. That's them. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the builder, He says, no, I got 200 grand. I sold a little piece of property or I got some inheritance. What should I do with it? They're going and thinking they're talking to a dietitian and they're really talking to the butcher.
Is that helpful? It's a little goofy, but every time I've showed it, people seem to appreciate it. So the fiduciary standard, let me just back up a little bit. So I think it helps to kind of understand the financial services industry a little bit. So the red and the red and the green are historically have a lot, like two different schools of thought entirely, right? So to be a professional in the red tools, the licensing, the oversight, the types of institution are very different than these institutions. And so you have what I call in the book red tools only advisors, and then you have green tools only advisors. So the licensing, the regulation, everything that goes into it, entirely different. And they generally in the past it's kind of one or the other. And so you kind of want to know who you're talking to. What's actually and it's kind of it's almost becomes like religion a little bit, or each points out the weaknesses or the strengths of each other of the other, kind of seeing them almost like competition. And the truth is, you want someone without bias or a fiduciary, right? So we're dual licensed. We're actually experienced in all the tools. We like to say we have all the tools in the toolbox, and we don't have an agenda other than how can we build a plan that's going to give you what you need, the most income, reduced risk, most peace of mind. That's the goal, and it's usually going to be a combination of the different types. Okay, so we're going to talk about some of the strengths of the red and of the green. And so there's some other vocabulary. So fiduciary, it is the highest standard. The vast majority of financial advisors in the world today are non-fiduciary. There is a trend that more and more are becoming fiduciary. And there's a reason why they don't want to become fiduciaries, because it requires transparency. It requires a higher legal standard. So you've got attorneys, you have doctors, and then you have financial fiduciaries. So fiduciary, is there any, I asked the last time, there's no doctors or no lawyers in here, right? But it's a legal standing. So, it's like if you don't do provide a fiduciary standard when you have a fiduciary role, then you go to prison, right? So it's a very serious deal. Most overwhelming investment firms out there, all the big names, most of them are non-fiduciary, and they don't want to be fiduciary. They want to. So there's fiduciary, and then there's suitability. And so if it's just suitable, it gives them way more leeway, and they charge commissions on investments and stuff. Fiduciaries don't do that. So anyway, just to kind of help you understand that. Hope that's helpful. All right, so understanding the trade-offs. Okay, so the dollar, if we go back to 1980 to 2021, the dollar will buy 70% less than what it could buy back in the 80s. So that's the value of the dollar that decreases over time. That's inflation, right? Because of inflation, the dollar doesn't go as far. And so we need to stay ahead of inflation. One of the best hedges of inflation is the market, right? So if we had that $1 in the S&P 500, for example, today it would buy 116% of what it could buy in the 80s. So that's staying ahead of inflation. So our money has to grow. You cannot, if you feel like you're going to be so safe that you're going to put money, in a savings account or just you're really, really nervous about it, you're losing money, right? Because your purchasing power will decrease. And so you can't have too much in cash. You want the right amount only for emergency funds, really, but the rest needs to be in somehow growing. There's lots of ways to do it, and that's why investing is important, okay? So here's the argument for why you want to invest in the market, okay? On any given day, if you look at, is the market up or is the market down? 53% chance it's up, 47% chance it's down. So it's pretty close to a coin flip, right? But if we go out 1 year, your odds that you've actually had some gains is up significantly, right? Still 25% chance you may lose some money. We go out 5 years, goes up to 85% chance versus 15. We got 10 years, looks like that. If we go out 20 years, there's actually never been a 20-year history where it would not have been better to be invested than not. Okay. So it really comes to time. So time, you don't want to invest in the stock market on a short time frame, especially heading into retirement. So what is the time horizon? And so when you're at retirement, you may feel like, well, I'm out of time. No, because you don't need all your money at once, right? So some of your money is going to have a longer time horizon. Some of your money needs to be earmarked for income. So some of your money needs to be in the market and some needs to be in more income structured tools, which we'll get to. Okay. Make sense so far? All right. Good place to stop. Let's just take a break. Snack, bathroom. Is 5 minutes enough? Should we do more? Okay, 5 minutes. So this book is an easy read. It was me after doing education events like this for for a number of years. I thought I wish I put this into a book. So the book you'll get some some things that are similar, but there's obviously could be some additional detail in the book. But it's not written to be. It's written to be easy to read. So hopefully you enjoy that. And this reminder, our free consultation. Hopefully you want to come in and sit down with us and we can chat and provide a blueprint for you, identify some different things, and just help you make some good decisions, what you might want to do. There's no obligation for that. All right, section 8. Retirement distribution risks continue. Okay, so when it comes to investments, we could talk probably a lot longer than you'd want, but if you think of, I like to refer to them as an investment platform. Not talking about any specific investments, but what are the platforms you can invest in? One model is a do-it-yourself model. It's where you would have an online brokerage account. You kind of get stock tips. You're making some decisions. Statistically speaking, and they've done a lot of studies on it. Statistically, it's the worst platform you can go with for a lot of reasons, right? Emotions. There's other things you're not thinking about. But anyway, there's that. Then there's probably one of the most popular are mutual funds. Okay, mutual funds were once, if you go back and look at the history, we'll do a little history lesson, okay? If you go back to like in the 1920s, it was very difficult for the average American to invest in stocks because they didn't have a mechanism. You had to have a broker in New York. It was just not easy. So they basically had a bank and savings account options, whatever the bank had, unless you happen to have a lot of money and you had some connections to invest. And so the mutual fund idea came around where it's like, hey, it's kind of like a pre-packaged portfolio. And you don't need a broker. You can just buy a fund, and this fund is managed by someone. And in the early years, it kind of changed the game. It made it so the average American could fairly easily invest in the market. Was that raising your hand?
No, I'm sorry, was that?
Oh, okay. And so they start, they were actually quite different back then than they were today. So because you had a manager. And so what happened was when you had a manager that was doing better than the other managers, everyone wanted to be with that manager. So mutual funds became very lopsided. You'd have one, big one. And then anyway, so the mutual fund industry, as it grew, they started making changes and they de-emphasized the manager. So you didn't know who it was necessarily. And they started making them into sectors and all kinds of changes. And then, as we went into the 70s, the 80s, the mutual fund industry just really took off in a very big way. And the way to think of it is they're kind of these prepackaged portfolios. But there's some inefficiencies with them, and I'm going to explain here in just a minute. But to make a long story short, to me, they're outdated. They're better options than mutual funds. Now, a lot of times, especially if you have a 401k or something, sometimes that's all you have is a list of mutual funds to choose from. So it's not like they're all, horrible. It's just that when you have a choice, there are some better options. So a 21st century thing are ETFs, exchange traded funds. So mutual funds are not traded on an exchange, right? So let's say you wake up in the morning, World War III breaks out, and you say, I really wish I was out of the market, and you really wanted to sell and get out, and you have money in a mutual fund. There is no mechanism for you to do that. The money in the mutual fund is not traded on an exchange. You have to wait till the business day is over, and then you can get, it depends on what the NAV is, what the net asset value is at that time, and then you can get out. So they're slower. A mutual fund is a company who's managing a fund, okay? So when you own a mutual fund, you don't own any securities. You just simply have a claim on the fund, and then the fund owns the securities. So it's kind of like a unique relationship. With an ETF, exchange traded fund, you can have a prepackaged portfolio. You can have all kinds of holdings in an ETF, but an ETF is traded on an exchange just like a stock. So very quickly, boom, boom, you could buy the whole market, sell the whole market. Okay. And so everything you could do with mutual funds, you can do with ETFs nowadays. They're transparent, they're lower cost, and they have become very popular since the year 2000. Almost no one had heard of an ETF, and it's just really been this century where there's been a big shift. But the mutual fund industry still has a huge hold just because the 401k, most 401ks are just a long list of mutual funds. And so there's trillions of dollars still in mutual funds. And it's not until people are retiring, they get out of their 401k options and they see the world of investment options where they make the change. So, and then there are separately managed accounts. We like ETFs and we like separately managed accounts as well. So there's a lot of advantages to a separately managed account. Sometimes ETFs will be used, but there are some disadvantages to an ETF as well. So for example, if you had a non-qualified account, a brokerage account, the ETF, you can't do tax loss harvesting very well, right? So they're not. So when you have a diversified portfolio of holdings, even if the market's doing well, you're going to have some of the holdings that didn't. Some of them were down, right? It's always the case. The majority may be up, but then when you have the ability to sell the losers and you offset the gains, there's a tax advantage. It's called tax loss harvesting. You can't do that very well with all ETFs. You can do that very nicely in separately managed accounts. It's called direct indexing, and it will save you money. But there's a good use for both of those. Who knows what this is? It's funny, if you ask someone that's under 30, they have no idea what that is. But back in the day, that was the cool thing, right? I mean, that was it. I think of when I think of mutual funds, I kind of think of an 8-track cassette. They have tax inefficiencies. So so let's say that there's a mutual fund, and let's say it owned Apple stock as one of its holdings for a lot of years, say 10 years. So that Apple stock has had a lot of appreciation, right? And now you come along and you buy a share of this mutual fund. And then the next week, that mutual fund decides to sell or liquidate that position in Apple. And so those gains get shared with everyone that owns everyone that has a claim on the fund. So it's called phantom income. So you actually have a tax consequence for the gains of that mutual fund that happened years ago. But just because of the time when they sold it, you were part of it, it's called phantom income. It comes in the form of performance. It reduces the performance because there's a cost, capital gains cost, right? So that's going to apply in a non-retirement account if you're holding it in a brokerage account. Anyway, mutual funds have bid-ask spread. They have price impact. So a lot of the mutual funds that are large, and if you have, they're $500 million or $1 billion or 5 billion, you can get some very large mutual funds. And if they want to sell or make a trade, making large trades for this large pot, there's a limit to how fast you can buy and sell something of that much, right? So it takes time to buy a bunch of stock or to sell a bunch of stock. And so the very act, if they want to buy a stock, they start buying it, and it could take days, right, for them to get as much as they want. And so it's like, oh, this stock, look, people are buying this stock. Well, you got a fund manager buying it, and then after he's done buying it, it settles back to what the real price is. And it's called price impact. And so it was like artificially inflated. It came down, and you owned it. And so, you just, they're just not efficient the way they're structured. The fees are certainly confusing. We see, we have portfolios come across our desk over the years, and it is not uncommon to see a portfolio full of mutual funds. And a lot of times they do a bunch of mutual funds feeling like that's going to be better diversification. But they don't realize that so many of the mutual funds are buying the exact same holdings. And so they'll have incredible duplication. They'll have 10 mutual funds, and all 10 bought Apple. They all bought Amazon. They all bought, and then every time they did that, there was a transaction cost associated with it. So if you're going to have some Apple, if you're going to have some Amazon or whatever, that's fine, but you don't need to buy it 10 times. You can buy it more efficiently, So it's like these little things that just make them underperform. And it's not a secret. If you look at Morningstar data, you look at historical performance, here's the market, here's mutual funds. They always lag because of these things. So we just try to stay away from mutual funds. How many remember Blockbuster? I mean, they were number one, right? They were at the top of their game. And they had this guy who came to them. He had an idea. And his name was Reed Hastings. And his idea was, sending videos in the mail to people rather than going to the store and picking up a video. And so he's like, well, who's the best and biggest? Well, it was Blockbuster. So what does he do? He goes, he meets with corporate Blockbuster, and he says, I really want to partner with you guys. I've got this idea. It would have been a really good thing if they would have said yes to him. But that's not our model. We don't want to do it. No. And so he goes out, he starts Netflix. So, I mean, they had 9,000 retail stores, Blockbuster. They took in almost $800 million a year just in late fees. And then Reed Hastings was in 1997. He founded Netflix. It did not take very long, and he had completely replaced them. and they went bankrupt. So that's an example of, to me, of old technology, new technology replacing old. Today I was thinking about, I don't know why, but I was thinking about just transportation. I was thinking of rail, like it was, and this is probably a little weird, but I was just looking at these numbers today. It was in 1869 is when the railroad was all connected and you could travel across the country by rail. I mean, do you know how long it took to travel before the rail? I mean, it was like a month or two. It was a couple of months of camping and traveling. When the rail first finished, you could do it in about 7 days because they still had a lot of stops and stuff. It was 19 or 18. Oh, I forget the year, but it was quite a while before you could do it in a day. You could cross the country, or you can't even do it in a day now. I don't think, right? It was a couple of days, a few days. And then I thought of flight. How long? You couldn't fly nonstop from New York to California, coast to coast, until like 1953. It was 1930 when you could fly all by air, but it had so many stops, it would take almost a week to get there. But anyway, it's just interesting to see how technology changed. Technology and innovation has very much been happening in the financial world. It's just not as apparent for everyone to see, but there really are some kind of older ways and there are some newer ways that are more efficient and better. All right. So one of the things that we really like about separately managed accounts is that we have access to more types of investments, right? So if you were looking at just in the United States, companies that have $100 million of revenue annually, okay, so we're not talking about startups, we're talking about substantial companies. How many of these size companies can you invest in on the public market exchanges? And the answer is it's only 25%. So there's actually a whole lot more companies out there, great companies. They've just never gone public. They're privately held. Company like SpaceX, I mean, it's anticipated that they will actually go public sometime in 2026. But we right now are already invested in our holdings. We have SpaceX, and even though they're not public, and it's because we're investing in private equity. So private equity. Well, let me just back up. So there's some changes, some things that have changed. Okay, what are some of the problems with private equity in the past? First off, private equity has been a strong investment, as I'm going to show you here, for decades. It's been a very, very good place to invest. But who's been able to access it and invest? It's really only been the large, hedge funds, super wealthy. And why is that? It's hard to access, and there's no ready market. If you want to sell a position here, you can do it in a day. Not so here. You might have to hold for years because you own a piece of a company that you have to have a buyer. Well, you got to find a buyer. And so unless a company exits and they sell or something, and then how do you get diversified? Because if you only have one or a handful of companies, then you're not diversified. So the average person had a hard time getting diversified, and they had a hard time with the liquidity issue. So it was only the big money that could really do it. So what's changed now is they've created what's called interval funds. So there's some of these large equity firms who have these diversified portfolios, and they have built-in liquidity. So the liquidity is interval, meaning it's basically, for most of them, it's a 90-day window. So if you wanted to sell a position, you might have to wait 90 days. That's in our book, that's highly liquid because it's still a very reasonable amount of time. It's not like years, right? And so now we can actually invest in private equity, be diversified in it, and So we don't have the risk and we have a high amount of liquidity. if We need it. And so now, if we look, this is looking at a 10-year period, 2014 to 2024. This is when the worst drawdowns of the market during that time, okay? So the gray is the S&P and the Russell here. So this is COVID. So you see when the market was down, these are all drawdowns in the market. The light blue is a portfolio of private equity. And they just don't have near the volatility and they don't have the emotion, right? So if everyone's spooked and the market's going down for, even if you wanted to sell, you can't because you might have to wait 90 days, right? So there's no day traders. There's no people getting in and out quickly. They're more long-term. And so you just don't see the volatility. So we like that a lot. And then we say, well, how has it performed? If we just looking at global private equity globally, it's almost 60% on average since 1994, where the global stock market has been around 9%. So it really has phenomenal performance with less volatility. Of course, we can't guarantee what past performance is going to be or is done, but we really like it, and we think it's an important part of your portfolio. It's not all of it, right? It's just a part. If you look at the trend, going to 2010, there's about $3 trillion invested in private equity, and it doubled by 2018. It doubled again 2023. It's expected to double again by 2029. So part of that is more people are gaining access to it. I don't know if you remember in the news a few months back, President Trump did a executive order that 401k plans would be able to have access to private equity. And so everyone was kind of shocked by that. I don't think there's a single 401k plan that actually has access to a private equity at this point, but it's just, he just kind of opened the door if they want to, and there's some, then that can be a thing. But they're so 401k plans they want it to be so easy in these mutual funds, right? So, but I'm sure there'll be some eventually becoming available in 401k plans. So these are generally referred to as alternatives, right? Alternatives to the public stock market. The public market, and if you look at the S&P 500, if you go back, 30 years ago, if you were invested in the S&P, you were actually more diversified than in that index today, right? Because there's been a lot of consolidation. I mean, almost a third of the S&P is like 7 stocks, right? So it's become very concentrated. And so we think it's important to be a part of, use the public markets. There's some, you've got some liquidity. There's some great companies in there. But that's going to be some long-term horizon money. Then you can have some private equity portion, and then there's even some more conservative that you'd want to have in the mix. Real estate, you can invest right in. So we're not talking about a REIT. Okay, a REIT is a publicly traded real estate trust. The private versions of all the different types are typically better for a number of reasons. So we can have right in an IRA, we can have part of your portfolio if you want, right into some high-end real estate, nice apartment buildings, with a strong track record, privately owned, income-producing real estate that can be part of your portfolio. And why do we like to do some different things? It's because we want true diversification. You don't want everything one way, right? When you really have different types of assets, they're going to perform differently, and that's going to do better over time. Structured notes, there's all kinds of structured notes that can be beneficial. probably won't go into details there. That would be like an hour just on that. But there's, you can get higher rates of return. So there are structured notes where we can get like a guaranteed 10 and with no downside risk under certain market. And then what they're doing is they're doing some options trading on a note. And so the notes might be callable. So if the market does a certain thing, then they say, oh, we're going to call that note. And then you're out of that investment. You have to get another one. So there's some things to know about, but you can accomplish some goals with structured notes that, anyway, we can talk about that later, I guess. Then there's Delaware Statutory Trust. So I don't know if you've heard of that, a Delaware Statutory Trust. So this is if you happen to be a real estate investor. So if you have rental properties, sometimes we'll have people come in, and that's where most of their assets are. We've bought these rentals, we've got 5 rentals or whatever, but we're kind of tired of being landlords. We want to retire. How do we start selling these properties? And if you have the tax treatment on an investment property is not the same as your primary residence, right? So if you've owned a rental property and had it for a period of time, you've been taking depreciation on it, it has appreciated in value. If you sell it, most people, when they consider it and they think about it and they get an estimate on what the tax implications will be, they're like, oh, wait a minute. I don't think I want to sell that. Because it's a significant chunk goes to capital gains. And they'll do a depreciation recapture on the depreciation that you took. And so you left, it's not a very fun thing to do because it's just a big tax hit. So in that case, for people that want to, they hold real estate, they're tired of being a landlord, they can now do a DST. They've only been around since 2004, so they don't have it's not like they've been around forever. But a 1031 exchange has been around forever, right? Since 1921. So a 1031 exchange, when you sell an investment property and you do a 1031 exchange, it's kind of like you're rolling all the gains over into a new property of like kind. And those are done all the time. But the 1031 is very specific. It's a very specific time window so that you don't have any taxes. But all that means is you're selling one real estate and you're moving into another. So if you're trying to get out of managing real estate, that doesn't really solve the problem. So with a Delaware Statutory Trust, it qualifies for 1031 treatment. So you can sell an investment property, do a 1031, experience no taxes, and it goes into a real estate portfolio. It's like a nice apartment building, or there's all kinds of high-end real estate, hospitals, medical facilities, whatever, but it's income producing real estate. And you have no management, you have no tax implications, you're just collecting the income, and they work nicely. So here's an example. Okay, we had a client, they had 4 single-family homes that they had bought in the Valley clear back in 1974 to 2006. You can see that, prices have increased a lot since then, but they had a lot of appreciation and they had a lot of equity in these houses, and they were cash flowing at about 4%. But they were like, we're probably going to have to replace the air conditioning unit. There's one that we're going to have a roof replaced. We really want to just retire, and we're just kind of sick of this. What can we do? So they were able to sell their properties, do a 1031 into a DST. So now, instead of owning 4 older homes, they're now part owners of a 129 unit senior living facility and 127 unit Class A apartment building in Texas. So now they're actually more diversified. Their cash flow actually increased, and their headaches are gone. And so that's just, if you happen to have real estate and worried about that, that's one option. And then there's another strategy where It's called the 721. So when you own real estate, so if you just keep it in real estate and you never sell it, then at the end of life, your heirs get a step up in basis. So they inherit it with no tax. But if you sell it, you're going to be paying a lot of tax. So there's another strategy. So you can put it in DST for 4 years, and then you can do what's called a 721, where you can separate your cost basis from your equity. So you can take the cost basis out. So all of your original money can come out tax-free, and now you have what's left is still in real estate. Anyway, I don't know how that applies to any of you, but just kind of exposing you to some of these different things. All right. So that's kind of the red tools discussion. All right. We love investing. We don't think it's something to fear. It's just something to get right. There's ways to do it and to do it well. All right. So let's shift gears to green tools. And this is where we really are kind of looking for some alternatives to bonds that are not sensitive to interest rates, that can do perhaps more than bonds. Okay. So let's talk about annuities. When I saw this image, this is kind of what I think of with annuities. Annuities have been around a very long time. If you look at their history, literally in Roman times, they had, evidence of annuities back then. So they've been around forever. There's a lot of different types of annuities. There's definitely some drawbacks on different aspects. If you go back to the kind of the basic of an annuity, it was a fixed annuity, meaning you put some money in here, the insurance company is going to give you just a fixed, typically low rate, but very safe. But it's almost kind of like an extension of a CD, right, at the bank. And then they said, well, okay, how can we take the benefits of the safety of an annuity, and how can we kind of marry that with the market? And that's where they came up with variable annuities. So variable annuities became very popular. They're sold by brokers still to this day, but you can still lose money. They come with some guarantees, but you can still lose money. They're typically high fees. And we've looked at, we have people come in, they've got them. So we look at them, and it's not uncommon to see when you add up all the layers of fees, it's around 4% that you're paying in a variable annuity. If you got a good one, maybe it's 3. So they're very expensive. We don't ever recommend variable annuities. The other aspect, which I guess kind of hurts some people, is where you annuitize. So you take some money, give it to an insurance company, and they say, okay, in exchange for that, we're going to give you some payments for a certain period of time, or maybe for life, whatever the contract is. And then they die 5 years later, and they never got nearly all their money out, and there's nothing that goes to the beneficiaries. And so it's just like not a very warm, fuzzy idea. So we never would recommend annuitizing. So it's understanding the differences. And so what are some of the strengths? So what we have nowadays, this is a 21st century thing. Didn't used to be around at all. Now they're called fixed index annuities. So with a fixed index annuity, so there's now a place we can put some money that is really going to be the foundation of an income plan that is guaranteed, you can't lose. And 0 fees, not 1 cent coming out. And the money can grow based on the performance of the market index. And they're doing options trading. And there's still a lot of different types and features that you can kind of customize to what you want, but it's different than you might think. So 2 main risks that annuity can help with is addressing market risk, addressing sequence of returns risk, and also longevity risk. So here's kind of the basic idea of a fixed index annuity. So let's say we have $100,000 in this annuity, and you can't lose that. Okay, it's guaranteed. Let's say the market goes down. What happens to your money? Nothing happened. It didn't go down. Okay. But now let's say the market's trying to recover. If you're investing, you're trying to get back to where you were. Well, because you didn't lose, you're starting off here. And so you actually get gains on that rebound. So you're getting the rebound without the loss, and then it locks in. And they're typically annual, where they lock in each year. And so you get this kind of stair-step effect. If the market's down, you lose nothing. If the market's up, you get gains. Now, you're not going to get, if the market has a blowout year, you're not going to get 30% necessarily, right? It's a more conservative part of the portfolio, but it's serving a very specific purpose to protect against sequence risk, market risk, to give you predictable income. And so it can be, a portion of assets with the right combination, and it can make a difference. So a couple of other things I'd point out here. There's what we call an accumulation annuity, a fixed index accumulation annuity. That it's simply, you put the money in. So think of it almost like any other type of account. It just has a guarantee that you can't lose. And then you simply will take withdrawals as you need them, just like you would any account. And those withdrawals can be automated and whatever. But it doesn't have an income rider. So you can have an annuity with an income rider. And what that does is it essentially becomes a pension. So if you have a pension from your company, it's an annuity. That's what it is. Social Security is a type of annuity. It's a government sponsored and funded with tax money, but it's annuity. It's a lifetime annuity. That's what it is. Okay, so that's with guaranteed income. So you can, and not everyone, your situation is going to be unique as to what features you might want. But for some people, you can actually get more money out of than you thought based on your longevity. So it's a protection against longevity. So here's just one example. I'll give you a couple examples. Okay, this one, you can get an annuity that's actually going to come with a guarantee of 8% growth for 10 years. So you know that the value is going to at least double. It's guaranteed. And then then you can start an income stream based off of that for life that's guaranteed to never run out. And the withdrawal rate is in this range, higher than 4%. So we can actually get more income out than what would be considered safe otherwise. And so they have what's called mortality credits. So let's say you put in a certain amount of money. You get out 15 years or something like that. And all the money, the amount of money you put in, you have received in payments plus interest. And if it was a normal account, the account would go to zero because you spent all the money and all the interest. But because it has a lifetime guarantee, it just keeps paying. And so that extra money is what they call mortality credits. It's income insurance. And if you have some longevity and you live past, age 80, it could become a huge windfall because it's just paying you far more than you put in. And so you think, well, how can they do that, right? And it's because they're insurance companies and they're using actuarial tables, actuarial science, rather, the law of large numbers. So it's kind of think of life insurance. So these type of companies, they're doing life insurance, they're doing annuities. And what do they have that no other type of investment has? They have actuaries, right? And so let's say that you were to buy a life insurance policy for $1 million. Okay, you pay a premium, you pay some fairly small amount to get that started. You're insured for $1 million. You go outside, you're hit by a Mack truck. Okay, the insurance company's on the hook for $1 million. Boom, that tax-free $1 million is going to your family. Well, how does that work? They can't do that. I mean, how can they do that? Well, it's because they're dealing with the law of large numbers, right? Because not everyone's going to get by the Mack truck. And so that's how insurance works. They pool the assets. With an income annuity, they're pooling the assets because not everyone's going to live past age 80. So some people, they aren't going to have to pay any extra. They're still going to get paid what they, deserve to get paid. But for people that live longer, they're actually getting much additional money, and it's just insurance money. So it's just a way to insure part of your income. And not everyone needs an income rider, but I'm just this is educational, right? Just so you understand kind of how they work. An annuity is the only financial instrument that pays you an income when there is no money left in the account. So we like fixed index annuities as an alternative to bonds. I mean, we'll still use some bonds, short-term bonds for certain percentage, but and it depends on your scenario. A larger portfolio is going to be constructed quite differently than one that's more modest. So it just kind of depends on what the goal is. This is Roger Ibbotson, PhD. He's Yale University professor in finance. This is a statement from him. He says, "I've always recognized you have to de-risk as we see that bonds are not necessarily the way to go today. Fixed index annuities can smooth out the returns since they never have a negative return." Right now, there is a fixed index annuity that has a 4% floor, meaning they guarantee no matter what the market does, you're going to get at least 4 with the potential to do much better. But, and we see double digits in these indexes in some years. I've seen over, 25% return in a fixed index annuity. Now, that's not going to be most of the time. I would expect around, 7 or 8, but you can actually have no downside risk and you can still have some nice performing on a portion of your assets. Okay. All right. So this is our financial house. So if you think of your money as your house, every house needs a foundation. The foundation needs to be a solid income strategy. It's going to include Social Security strategies. It's going to include if you have a pension or annuities. Okay. And then the walls are for the growth. And that's going to be diversified between publicly traded securities as well as privately, and having more assets in the mix than you probably had before. And then the roof is just making sure you've got all of your protection in place with insurance, estate planning, long-term care solutions, which I'm actually going to talk about here in a minute. But that's kind of what we seek to build. All right, so I think this is our last section, section 9, long-term care. We all doing good? All right. So I think that you would all agree, if you had your wish, you'd like to live a long, independent life. Then when your time comes, you pass peacefully in your sleep, right? That would be the ideal way. So statistically, about 30% of us will go from independence to dying. It's only 30%. 70%, we tend to need care. We die slowly over a period of time. And so 70% of us will need some form of assisted living or long-term care. And we do live longer, so we need our money to last longer. We see longevity as a risk multiplier because the longer we live, the more money we need, the more chances you have for all the other things to come into play. And what do you think is the fastest growing segment of our population today?
Baby boomers.
And it's it's the older ones, but did you know it's age 85 and older? That's the fastest growing segment. In 1950, we had approximately 3,000 people that were 100 years old. And it's projected by 25 years or so, we'll have 1 million Americans that are 100 or more. And with some of the AI, they're saying it might be a lot more than that. Well, who knows? A lot of times people will talk about life expectancy or average life expectancy, which is around 79. It's 81 in the United Kingdom, 82 in Canada. So I'm not sure why they're outliving us. I guess they eat better. But the thing that's misleading about the national average is that it takes into account this is from birth, right? So it takes into account infant deaths, childhood deaths, opioid overdoses, all the things are bringing down that average. So if you've made it into your 60s, your life expectancy is closer to 85, 86. And then, of course, there's a lot that are going to go past that. So this is my dad and I. And this was about 5 years ago. I can't believe it's been that long. But any guesses on how old he looks? He was 92 in this picture. And he actually died 2 years later. He was 94 when he died. And the thing is, he should have died probably a lot earlier, because when he was 65, he had quadruple bypass surgery. And back when they opened up the heart and did all that, right? Who died more, right? They do it more laparoscopically or whatever, or put in stents or whatever. But anyway, I mean, he would not have. He was off jogging and he's feeling numbness. He's like, I better get this checked. They're like, yeah, you wouldn't have probably lasted very long, and totally extended his life. Modern medicine. So we definitely live longer. My dad was a World War II vet, actually. Right at the tail end of World War II. But anyway, my mom, this was I think their 65th wedding anniversary. My mom's doing well. She's 92 today. And she's going great. She's doing great. So this was when I put this slide started putting it together several years ago. Emma Morano was the oldest living person at 117. On her 117th birthday, the camera crews came and they were making a big deal of it. And she was saying things like, is my hair okay? You know? And I'm thinking it's amazing she has hair. But after she passed away, then it was Violet Brown. She also lived to 117. And Navi, 117. 117 is kind of the number.
Yeah.
And then there's this guy. Okay, this story kills me. Okay, so Baljeet Singh, he was the oldest person to ever run a full marathon at age 100. He did it again at 102, 103, 104. He ran a full marathon. And then he stopped running marathons, and he just would go to the marathons as kind of this celebrity. But he just died in July of last year at 100. I think he was 109. And he was doing great. And here's the sad thing. He did not die of natural causes. He was crossing the road and got hit by a car. Isn't that the saddest? Because I was always following this guy, and I was so interested to see, because I'm like, the guy's going to live a long time, and then he gets hit by a car. So anyway, he was known as the Turban Tornado. All right, so if we end up with dementia, Alzheimer's, or some other thing where we need care, the cost of care is expensive. So, and this isn't a fun subject, but you kind of have to think about these things and plan for them the best we can. This is showing in 2024, a semi-private room in a nursing home, $9,277 a month. It's projected by 2034, it'll be $12,468. And then you can see the private room. And then, if we're looking at assisted living, having people come to your home versus, having to be confined somewhere, So there's lots of different, I guess, levels of care, but it's certainly expensive. So how do we cover long-term care costs, right? So there's four common ways. One is you just plan to think you can do it and you cover the cost yourself. May not be the best idea. Even people with higher net worth, there's some tax advantage ways to do it. So there's always a way to improve. Asking family members to take care of you. Now, even if you have some children that love you and say they're going to take care of you, you just have to think really hard about that one, because it could become a burden on them, much more so than you may think, right? And they may not have the equipment or the ability to do what needs to be done. And so that's not always a great option. What's ideal is to have your loved ones supervise your care, but not actually providing the daily care. Rather have, professionals doing that. So there's traditional long-term care insurance, not very desirable these days. It's kind of like almost having a second health insurance policy. You pay for a premium and you have to continue to pay it your whole life. You stop paying and then the benefits go away. The premiums are not guaranteed. It's expensive. It's hard to qualify for. When most people are at this stage and they look at it, they're just kind of like, no, I don't. It's just too much. It's just kind of unreasonable. And there's not even a lot of insurers that even want to do it anymore. It's just too hard for them, too expensive. So there's been some innovation in this department. Some of these life insurance companies have gotten creative, and they have developed some policies that are designed for long-term care. So we call it a hybrid or an asset-based solution. And they can work quite well. I'm going to tell you a little bit more about that in just a sec. But does Medicare cover long-term care costs? Zero. Medicaid does, but Medicaid requires you to spend down all of your money first before it would kick in. So it's called the spend down rules. So they'll allow you to have $2,400 worth of countable assets. And so if you have a situation where you have one spouse that needs care, and then you have a healthier spouse, that's called the community spouse, is allowed to keep one house, one car, and up to 162,000 of assets is all that you can have. And anything more than that, then your spouse wouldn't qualify for Medicaid. So it requires you to really spend it down. So it's kind of a, not necessarily an ideal scenario. Long-term care insurance, the traditional kind, it's use it or lose it. You usually having to submit receipts and get reimbursed. There's some newer types that don't do it that way. Okay, so now, whether we're talking traditional long-term care insurance or this newer type that I'm going to tell you about, they're all basically based off of this, we call them the 6 activities of daily living. So if there's 2 of these items that you need assistance with, and the doctor says, yeah, they need assistance, that's the trigger for the insurance benefits to start paying out. And plus, or in addition to these, it'd be also a cognitive diagnosis. So that triggers it, or 2 of these. And that's pretty standard across the industry. So here's an example. And there's a few different ways that these can be put together. This is just one example. Let's say that you got one of these policies, and it's going to, let's say, for example, you have $500,000 of a death benefit in a policy. You can no longer perform 2 of the activities of daily living. They're going to give you 2% of the death benefit per month, or $10,000 a month, tax-free, until it runs out. So for 48 months. So if you look at long-term care stays, if you average it out, it's around 4 years for women, 3 years for men, typically. Of course, it can be longer with, Alzheimer's or something, which is really the worst case scenario. You could live for decades needing memory care, nursing home type situation. So that would be the most expensive. The worst scenario is that. But on average, most people, if you've got a plan that kind of covers you for 3 to 4 years, you've got a pretty good plan in place. And it's not necessarily intended to, it doesn't have to be to cover every expense, because you're going to have some other income sources, but it's some extra amount to help protect maybe the healthier spouse. And these things come with tax advantages. So you could take some money that's not tax advantaged, put it in here. So let me tell you another way this could work. You can take some assets, put some money into a long-term care policy that gives you, let's say, a 3 multiple of value for long-term care that you put in, guaranteed, and then it'll increase based on inflation. So it gives you some nice protection, tax-free. But then if you don't end up using it, you don't end up needing it, everything that you put into it, and typically more, is going to pass as a death benefit to your family. So either you or your family is getting the money back in one form or another, and potentially a larger amount if you actually need the care. So definitely better solutions out there to consider. There's also a life insurance retirement plan. So this is going to apply to certain people and not everybody, but it is one of the greatest tax advantages in the tax code. There's definitely been a lot of innovation. It's kind of like having a big Roth, because it's all tax-free. There's no contribution limits. There's no penalties for withdrawal, no required distributions. The more money you have, the more likely you're going to want one, because they're just such a big tax advantage. And now, so in the past, you would typically expect like a 4% growth rate in these. So not very exciting from a growth standpoint. But now these have the options trading where you're getting fixed index, and you can get much nicer returns and more flexibility. They have to be structured for the right person, but just this is educational here, right? We're trying to cover everything. It's a green tool. So money, think of it as people think of life insurance and they're thinking, well, that's just if I die, right? No, it's very much for living, because it becomes like a Roth, and you can access tax-free income for retirement, and it'll double for long-term care. And you die, it's a tax benefit to the family. So there's a lot of reasons why life insurance can make sense. You could have, we have a lady, she has $1 million IRA. She's older. She doesn't need it. She's got other sources of income. She's got some rental properties. She has a very modest income. And she says, Lane, my son is just going to inherit that after I die, right? Well, if he inherits, and he's a professional, so if he inherits $1 million IRA, she's in like the 12% tax bracket. He's not getting the 12% tax bracket because it goes on top. He has to empty the whole thing in 10 years because they've shortened it for inherited IRAs. So he has to pull out these large chunks of taxable income on top of his regular income. So that $1 million, he'll probably get $600,000 out of the million, right? It's a big loss. And so she can do Roth conversions to help shift some of that. She could also buy $1 million policy, take the RMDs that she's not spending to pay for the premium. Now, when she dies, her son gets $1 million tax-free plus 6. So now he's going to get 1.6. And it didn't change anything in her life. It was just good planning. Anyway, there's just lots of little ways to put together, depending on your situation.
So this $1 million the IRA, you convert the life insurance into retirement fund, is it possible?
Well, to be converted to Roth and or to life insurance. Yeah. Yeah, you're still paying tax either way when you do in the process. But yeah, well, in her case, it's the RMD that she's forced to take out was paying the premium. But if depending on if it made sense, there are situations where it can make sense to put you're taking withdrawal from the IRA, you're paying the tax, and then you're funding it into one of these. And it's not gonna, it's very custom for the right person. So whether we're talking annuities, so when we're talking green tools, if we're talking annuities, we're talking these different life insurance strategies, how safe are they, right? So these are rated by these independent agencies on their financial strength. So you want to be dealing with an A-rated carrier. And just to understand what it requires to be an A-rated carrier. You have to have 100% of reserves at all times. So very different from the bank. So in other words, an insurance company is in the business of insuring, so they can't take risk on the money. And so they have to have enough money that if every obligation came due on one day, they have to have the money to pay it. Okay. Now compare that with a bank. Banks do fractional lending. And so they have very little reserves and they lend out the money. If everybody comes to the bank and say, hey, we need all our money today, they don't have it. It's a run on the bank. It's a crisis. It's a problem. The federal government guarantees up to $250,000 to protect against that. But an insurance company doesn't have that luxury. They have to, by requirement, they have to have 100% of reserves. And then in addition to that, they have to buy insurance on themselves. So if an insurance company actually managed to get itself into trouble, bankruptcy is not a legal option. It goes into what's called receivership, and you get absorbed by another insurance company because they have reinsurance. And then if for somehow that fails, every state in the country has a state guarantee fund. In Arizona, and most states are in this range, but in Arizona, the state requires the insurance carriers to pay into this fund. So they guarantee up to $300,000 life insurance and $250,000 per annuity. So it's about as stable as you get from an A-rated insurance carrier. So if you have a sizable amount here, most people have most of their money here. But if you've got a big chunk here and you want to get that more tax efficient, your contribution limits are limited to Roth, right? If you've got a bunch of money here. And so that's where the life insurance strategy comes in because there's no contribution limit. And so you can have, and we've seen, $20 million into the life insurance strategy. It's very much a thing. Anyway, so there's that. And then, of course, it's conversions, getting tax efficient, going to Roth. So when you have some green tools and you have the right balance where you don't have the downside risk, we use it as a volatility buffer. And so as long as you have the strategy, we can almost completely eliminate sequence of insurance risk because of the strategy that's in place. And the key is if the markets are down, you don't take a withdrawal from your market-based investments, you take it from your green tools. So you have to it takes a combination, and then sequence risk almost goes away because you've got a plan that actually protects against it. So plug in the holes. This is a kind of an example of what we see. We'll have someone come in and we'll say, okay, let's see what you got going on. What's the probability of success if you just leave it the way it is? And then we'll make some changes and we'll make some additional changes. They really are, it is that significant to have a good plan and to be more efficient, to reduce risk, and to optimize your growth at the same time. So. And I mentioned this, we call it the 5W retirement blueprints, the 5 key areas. It goes, we look at each thing. We have the appropriate liquidity, tax strategy, income plan. So you have the peace of mind, you can enjoy retirement. That's our goal. And if you haven't seen our whole team, this is our team. And we do service clients all around the country for those of you that are watching remotely right now. And, the world changed with COVID because now we meet with clients via Zoom all the time and it's very convenient. So you got the book, you got the green sheet. Appreciate if you fill it out and leave it with us. And we hope that we see you back and hope, was this good? Was this educational? All right. Thank you. Thank you. That makes it all worth it. All righty.
I can take your green sheets if you want to fill them out right now. And then if you'd like to schedule, we have a board out there with a couple different time slots and days. So whatever works best for your schedule, just take it, we'll schedule you there. So.